Hello traders, Gary Wagner here, just after 11 o'clock in Honolulu, 5 o'clock in New York. It is Tuesday, 7th day of August, 2018, and this is the daily report for gold and silver. We do have fractional gains in the precious metals markets, with gold futures as basis most active December, currently trading up $1.10 at $12.1880. Spot is faring much better in terms of price changing, up about $3.50 at $12.1080. Silver has shown some gains today, up almost 4 cents on the day at $15.38. Platinum trading higher, gaining over 0.5%, $4.80 gain at $831.10, and palladium trading marginally lower, off $1 at $9.02. All of this in light of a weakening U.S. dollar, just at or below that critical psychological level of 95, currently at 94.995, down about 0.2%. In terms of equities, there have been solid gains today. 126-point gain in the Dow, 25,628. Standard & Poor's gaining a little bit over 0.25%, 8 points at 2858. And the NASDAQ Composite gaining about 0.3%, up 24 points at 7883. Lastly, Bitcoin futures continue to decline, although marginally. Today's decline amounts to approximately a $35 drawdown at 68.85. Traders, as you know, I have been bearish on the precious yellow metal, looking for gold to track and trade lower. That is, in fact, what we have seen over the last couple of months. One of the key factors that I have been looking at in terms of that determination is the fact that we had this death cross occur a while back. And of course, on a technical basis, that is a point in time, according to technicians such as myself, that we're witnessing a short-term correction morph into a bear market. And I absolutely believe that is what we've seen ever since gold effectively traded to approximately $13.69, $13.70, matching these series of tops, taking them out, but on a closing basis, not able to have any kind of sustained moves, and most importantly, not able to challenge the highs that came in immediately following the end of the long-standing correction, and that, of course, occurred at the end of 2016. When gold bottomed at about 1040. Now, I have labeled the short that I issued yesterday as a very aggressive short. I am hoping that the majority of our subscribers went short much higher than this immediately following the FOMC meeting. When I sent out the gold outlook, it wasn't a trade alert, but I was indicating that I believe we would see lower gold pricing. I know that many of our subscribers got short then. The reason for calling this aggressive is twofold. One, we are seeing some real potential that we could be witnessing some sort of a bottom or support level, and that is simply on a technical basis. Because when we look at where the market lows have come in recently, we get this conjunction of different fib retracement periods, both coming in at a 50% marker. And the most interesting one, as far as I am concerned, is the fact that when we look at the lows of 1045 to the highs of 1377, and then when we look at the lows of 1124 to the highs of 1370, the 50% mark, the halfway mark for both of those, comes in roughly at $1,200, $1,208 and $1,211. And so for that reason, we have seen the market really give back half of the gains, whether we look at the extremely long-term move in the market or the shorter-term move. But in both cases, we get this harmonics that is occurring roughly in this area, because the next real level of harmonics comes in when we look at the bottom here at 1124, and a 78% retracement at 1117. So my sense is that should this roughly $1,200 area not hold, we could see gold prices headed substantially lower. My first target would be the point of a 0.78% retracement. That comes in at 1178. And that is where I believe we would see gold fall to if, in fact, we see a break below this particular cluster of potential support. Also, historically speaking, when we look at recent lows, this one coming in July of 2017, and this low just below it coming in about May of 2017. They come in roughly at the same area, 1200 to maybe a 1208. And so we do have these two lows, and they do match up roughly with different fib levels. And so because of that, and then here, I am looking at least on a technical basis for that potential. However, the fundamentals remain that if the dollar remains firm and gains ground, if the dollar can effectively find support at 95 rather than resistance at 95, we could easily see a break and see a break below these current lows. It is for that reason that I'm labeling this an aggressive trade, and because of that, I'm also keeping our stop extremely tight. Traders, the last leg of this trade, if you only put it on recently, you're in at about 12.17. We have these highs up here that come in at 37, and then a cluster of highs at 28 and 25. And so it was really putting it above 25, which is what I said in our trade alert yesterday that I'm looking at. Because what I believe is if we take out these recent highs here, the fact of the matter is we have seen a series of lower highs coming in for the last 6 consecutive days. At the same time, we pretty much have a flat bottom in the market, and on a real microcosm, it really is reminiscent of what we saw at the top of the market, where we had really a flat top and we had an ascending bottom. We had a series of highs coming in. And of course, once that was broken, we were off to the races in terms of going into a major retracement, a short-term correction, and then the confirmation that we had moved into a bear market. And considering that this market was trading at roughly $13.70, we have seen a decline, of about $150 now in gold when we look at activity over the last 4 trading months. It is for that reason that I believe we could see continued declines in the market. All things being equal, we know that if the dollar stays strong, we'll continue to see the metals under pressure. Because at the same time, we have a risk-on environment that is favoring U.S. equities. Equities have been driving to higher pricing, and the dollar has been strong. We had originally perceived or believed that the effect of a trade war would be a rush to safe haven assets, and nothing could be farther from the truth, at least up until now, because what we have seen in the market is a flight to a safe haven asset, and that asset has been the U.S. dollar. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.